Tech started out with a bang, just started selling down, unable to hold that 13,000, which is exactly what we needed it to do. With several earnings companies coming out this evening, people were concerned. Huge tech earnings this evening we'll go over, but you can see we're unable to hold that 13 level. As the day persisted, it just got worse. We saw more selling, unable to rally, just as the fear of earnings. There's a lot of chatter on the desk today about Microsoft missing earnings. That was floating around a lot of institutions, and we're going to get into that, but it's really important because earnings after hours changed the entire tune. What the smart money, dumb money confidence chart is telling us, let's get into it. Hey everybody, welcome back. In tonight's video, we're going to go through the key levels in the indexes, what smart money, dumb money is telling us, and several earnings, especially with what's happening with Microsoft, Google, ENPH after hours. So let's just get into it. First and foremost, this 4,200 is set, and we are just not seeing any signs of this breaking whatsoever. We've been talking about it for over, since August at this point, and it's just not going anywhere. Sometimes you try, and then we get excited, and then it comes right back down. But we're staying in that 41.80 range. So you really have a range, in my opinion, between these. Some will say 70 to 80, but if you just kind of look at it as a band, you have a really tough time up here. And we could refer to this as a supply area, and this is really where you start seeing a lot of supply. It's where people start offloading, right? So if we think about it from that perspective, we know where the upper band is. The lower band's really been around this 3,800. You had some issues down here that actually were a little lower. The 3,850 was trying to hold for a little bit. You know, you still have those higher lows for sure. I mean, we can see the higher lows, but let's make that one a little bit better. But at the end of the day, you're still in this range and you're still bouncing around here. Now, this is not what you want to see today in this kind of break. And we're going to go through this with the Nasdaq too. This is definitely not what you want to see. And this is just us rolling a little bit. And this is just a full bar of the open is the high and the low is the close. This doesn't really get any more bearish of a bar than that. Now, that 4,100 level in there, 41.95, 96, right in there, you seem to have held. So the hope is that you're holding that 40.80. If you start breaking that 40.80, they're just going to walk us down. Then it'll be 40.40, and they'll just keep doing it. So I would just suggest that when you start to see this, just have your brakes on. Now, earnings tonight could change that, and we're going to have to discuss that. But I can only tell you what I see right now. And all I see right now is that red bar. So we know how we're boxed in here, and we see these levels. I would also say that it is troubling that if you look at my line, and let's pull this up so that you can see it very clearly. So I have several clouds in here. Each of these clouds are different levels of magnitudes of relative volume. And then they all kind of go together. And when you start seeing these outliners, the colors change. That's how I have my volume set. Now, when you start to notice that all your red volume is the one that's above average, and it's above average, but it's also not an exhaustive bar, you need to pay attention because it's telling. See how it's over here? And you start having these red bars, but it's not really an exhaustive bar, right? And then what happens? You get this little rally, and then you just see massive selling, followed by what? Massive selling. When's the bottom put in? Okay, so you need to just be aware of it. It's something that it's on my radar, and it's not something that I'm really crazy about. Now, again, when we go over earnings tonight, you'll see why this could stabilize and change, but you still have to deal with this bar. That bar is not going to go away solely because of one earnings night. We have to deal with it, and we're going to have to see how we're going to acclimate to it. But we should really talk about the Nasdaq. Now, we've been talking about these levels for a very long period of time, but let's just mark them off again. This 13.2 that's right up here. We've been talking about this for weeks, right? And we actually even mentioned the fact that you could start seeing this little bit of a slope that was kind of coming down on it. And I think that's pretty clear that you can see that right in there. And it's kind of rounding. You weren't able to get through this level. Now you're trying to figure out what to do with it. Well, let's get rid of all of them for a second. I think there's a couple different ways to look at this and to kind of skin the cat. First and foremost, you have this trend that's right here. You have this trend line, and that's your big trend line, and you really have not broken that, right? So that's not really falling apart just yet. But you have these other minor ones, such as in here. And if you clone this and drop this in, well, you can see that you have a pendant right there. Now, if you take this one out and you look at your pendant, well, you broke your pendant today. Okay, let's say that you don't like the fact that you don't like my channel for some reason. If you look at it this way and realize that this was a flag, well, you broke out of your flag today. Right? Let's say just placate me. This is a flagpole. This is us going sideways with the flag. This is us breaking down out of a bull flag. That's a failed pattern. No matter how you slice that pattern, no matter what you want to name it. I don't care if you want to call it a banana. It's a failed pattern. So now the question is, what next? Now, the Nasdaq itself, this was really a very easy trading day. So you have your levels right here, the 13. So you came down, and we've been watching this 13. It had to hold 13. And what you wanted to do was you wanted to short this once it retested that level. So in other words, what you wanted to do is, here's your break, right? And most people will short that break, okay? And I'm not saying there's anything wrong with that. You can. It's definitely one way to go. But what's a little safer, considering how many times we've broken and then not gone, is you wait for a retest of the area, and sometimes you get them like here. And then once we got these retests, even here you could have used, once we got this retest, it was pretty clear to go short, and I actually went short and bought puts on this, as well as several different names today. But the important thing about this is getting the concept that you want to see it retest that level, bounce off that level, and then see how it acts from there. Retest that level, and then it broke. And then we did the same thing, or I did the same thing, I should say, right here. Came right back in again, couldn't hold again, knew that this was now the new level, and then we sold down. And that takes us into this evening. I think it's a good time to have a refresher and talk about the relative performance of the Nasdaq versus the S&P. In bull markets, you want the Nasdaq to outperform. And that's exactly what happened when the pandemic, and then we kind of went sideways from there, bouncing around. One would outperform, one would underperform, until finally it broke. And that got us a resistance or a neckline. And that neckline's now been around for years. And it was tested here back in probably looks like around March and April of 2020. Then again, obviously in May. And then more recently right now. And we have clearly rejected that level. So that is something that's weighing on us. So we're really going to have to start seeing some buying and watch that buying come in and who's out there that can buy right now. Now, smart money, dumb money. As we like to refer to it, this is institutions, this is retail. And what we're seeing is the same patterns play out over and over again. And we should talk about them because it's somewhat telling. You take a look at retail, and you look at when retail is filled and peaked. That's equating to peaks in the S&P. And we're seeing that repeatedly. We take a look at this peak when we're over the optimistic line, and we've gotten a little too giddy. See right in here as well, gets a little toppy. You can see that we are a little toppy in here, and then that follows through because of this, right? And now you can see right here, we're starting to get a little toppy, and maybe that is one of the reasons that we're seeing this happen. So we have to understand where we are. We're in a position where we're getting a little toppy. We can't really look at the pandemic and take anything from that because we're fully aware of those types of situations and what, the difference in what happened there is circumstances that we're not going to see again. But what else can we take from this? Well, we can also take that usually when the least amount invested by smart money is down here, and we look for those kinds of levels and see if you can see any kind of pattern whatsoever. And when you start getting close to this line of pessimistic line is really what it is, whether or not they want to participate or not, and this is where you're at. And you start realizing that when they get to that level, drill in straight from here, I'm just going to lift it up, you don't really get a lot all the time that's telling you anything, right? Like you're not really getting much from this, except that maybe that there's this spread in between these two that maybe we should be paying attention to a little bit more. And that's really where I'm going with this. So if you look at this, you can see that there is a huge spread between smart money and dumb money, or as we call to institutions and retail. And why is that spread important? Smart money, dumb money, confidence spread. And as we referred to it before, we refer to it as institutional and retail. Now, I think it's important to make that distinction before we go forward because we're looking at 10 years and we're looking at the spreads on those 10 years. But we're going to see some things here. So this green line is when you are above the spread. In other words, when smart money is way more confident than dumb money, or as we refer to it, institutions versus retail. The red line is when retail is way more confident than smart money. So if you look at this as a spread, you'll note these peaks at the bottom when you're under this level. And for our intensive purposes, we're going to shrink down the time frame. So I shrunk the time frame down to five years. And this is when retail, the spread gets way too swayed. And if we just come here and we take a look at that here and here. Now, the pandemic I'd like to leave out, and I'd like to leave this out because it was such an anomaly. But if we take a look here, and we can even use this spot right here, we can see this very clearly, right? So then just come to those spots when retail's in charge, and you just kind of mark them off. You can see from here, and it gets pretty clear that when the spread and disparity is that much, that you're probably not going to want to be in that position. And that means that we probably don't want to be too long up here right now until this resolves itself. This kind of makes sense if you think about it, because can retail support the market? No. We need institutional money. And if we don't have institutional sponsorship, then after retail runs out of powder, which we just showed on the other graph, well, if institutions aren't going to play ball, there's not really a whole heck of a lot that we can do that's going to continue to perpetuate the market forward. To accentuate this, I'm just going to show you again, just on 3 years. You can see your level right here. I think it's a little clearer on the 3 year here as well. And then here. And this is where we're at right now. And the question is that what's going to happen, here? And I don't have an answer to that, but I do think, let's put that as a circle. But I don't know that it's not going to happen. And I think that we need to pay attention to this. This is not something I would sleep on. Because when you run out of people that are buying, I mean, if you just think about it from that perspective, you have a problem. You need buyers. Now, there's a lot to go over here, so we're going to cover them, 7 in particular. So Verizon actually beat on revenue and on earnings. You can see that right there. The most important thing that I would say about this, if you could take one thing from Verizon, if you're interested, just watch this level, this 235. You couldn't break it tonight, and that is telling. The fact that you could not get through there, so just pay attention to that. And you did see sales, or the amount of times cards were used, activity was up 12% year over year. That does bode well for retailers, but for Verizon itself, just watch 235 tomorrow. Google is up about $4 after hours. It was a really decent quarter. They beat on the earnings front and they beat on the revenue front, but they're doing a $70 billion buyback. Now, we're only really up about $3, which is somewhat interesting, and I think you still have that overhang of Microsoft and the AI competition, and we're going to address Microsoft here in a moment. And I think that's playing with a little bit, but that's really very powerful, them coming into the marketplace and saying, hey, by the way, this cash that we have, we're going to put it to work. We're going to buy our own stock back. So I did view this as a positive catalyst. Now I want to take a moment and focus on PAC West. Now, when we start this with the regional banks, we're aware that not every regional bank is going to go to zero, and they're not all that big of a disaster as First Republic, which was an absolute dumpster fire. We can all agree on that. But if you take a look at PAC West, they reported earnings. They beat on the earnings front. Okay, not only did they beat on the earnings front, okay, they came, to come in higher to start there, but this is just staggering. Total deposits increased. So as everybody's losing money, they're increasing their deposits versus the same period. So, think about that for a moment. Between March 20th and March 31st, they added $1 billion in deposits. So we did see a huge rise in this. Now, the reason I'm spending a lot of time, particularly on this one, is the conference call is tomorrow at 11 a.m. Okay, that's what's on record. I have it lined up. And 11 a.m. Eastern Standard Time. So this is going to be very volatile tomorrow. Now, the reason I'm saying that is because you're looking at this and you're not seeing how, you're not really seeing it go anywhere, right? We talked about this graph the other day, and we're going to talk about it again. And this just shows percentage of deposits and where they stand on a percentage basis under 250. And this just shows the high end, where the disasters were. Dumpster fire went to zero. Wonder how this is going to play out. And you can just kind of see who's up next. But PACW's got me right along that line. And if they're going to come out and they're going to have an increase in deposits, and when you start going through this quarter, it's pretty impressive. Now, if we drill into this, this is one of our support lines and resistance lines, and we tried to get through it. We were unable to. But You might be able to get through it tomorrow with the conference call, and we're going to have to see how that goes. Can they actually get above this? You're kind of resting on it right now, but you really want to blow through it and keep moving higher. And I think that I don't know that there's a company yet, let's look at it this way on the hourly, it's just easier, that has actually come out that's a regional bank and had an increase in deposits. So I think when this starts to settle in, and no one's really paying attention to this because we're paying attention to CMG and Texas, and we're going to get to those ENPH, but this is fascinating. And I think there's a lot of opportunity here. So it's going to be really, I'm very curious to see how this call goes. I know it scared the heck out of everybody today with FRC and scared the regionals. And I think this might quell some of those concerns and present opportunities in other names. CMG hitting all-time highs. I mean, it's pretty staggering. Pretty sure that's all-time highs. Check in a moment. 17.5% they beat by. So that's the beauty of inflation with companies like this. You're going to see this with Wingstop as well. Let's double check that what I'm telling you is true. It's not all-time highs. So all-time highs would have been here. It's a multi-year high, but it's not an all-time high. 1956, 1960 up there is where we're at. So we're still got about 30 points, 40 points before you can actually say you're at all-time highs. But it's getting there. And what happens here is these companies, they don't go away, meaning they don't lower their prices just because inflation comes in. It becomes demand. When demand slows down, then they'll lower their prices. So the prices go up during inflation, they just never come down. That's always been the way, the way that things work, and that's one of the things that you're seeing here. And you're going to see a lot of these food companies like this benefit from that. One we were talking about in the community today was Wing. You can see how that's acting. It's already breaking out, getting ready to, if you didn't hit all-time highs, and earnings are Wednesday, May 3rd, and yeah, all-time highs. So you're going to continue to see this kind of activity in specialty foods, especially with their costs being down now. It's just the way that it works. Texas Instruments did not get a lot of play, but you're up $3 after hours, and I think it's worth mentioning, considering with how horrible semiconductors were today. You're up about 7 cents over, so about 4% beat, and you just beat on the revenue side. I just think it's important that we did get down to that 200-day moving average, and we did hold. But this is a pretty nasty bar, so I'd like to see us get back over the top of that bar before we even consider doing anything with it. It's not an ideal chart, but maybe this lets it hang on and build a base before moving higher. So the question everybody's asking is, what the heck happened with ENPH? Well, it's really simple. They beat on earnings and revenue, but it's always, what have you done for me, next quarter? And this quarter coming out, they did okay, but they came out and said, by the way, we could miss revenues up to 10% quarter. That's not ideal. So you're seeing the stock down about $40. You need to hold this 183.50 level. You're hanging on by your fingernails in here. If that breaks, it's a long way down. There's very little that is going to hold this up, that chart, right? Technically, it's broken at this point. If you start looking at your real trend line, and we'll draw that in real quick so you can see it. This is a long one, but I prefer to do one from here over so you can see that one. No, you're not broken yet, are you? I thought you were for sure by looking at it, but you're not broken yet. You're still there. That's good. You're still there. My mistake. So watch this whole range in here. But that's pretty much where your range is going to be on this. And I don't know how they're going to spin this tomorrow with some of the firms that were pounding the table on it ahead of earnings. But the big winner of the night was Microsoft. So one of the things that you will notice today that you may have seen all around, including even names like Amazon, was we saw them taking absolute hits. And they were taking hits on the day because the rumors going around was that Azure was going to have a really bad quarter, and that the quarter was going to miss. And this was leaking for a couple days now, and so you can actually see it in the stock and how it started to leak out. And we couldn't figure out why there was weakness, and then it was out on some desk chatter notes that I get from institutional desk rumors. And when I was reading it, I'm like, well, that seems reasonable, right? That could be weak. And if I'm reading that, all these other people are reading it. So what's happened was it just wasn't weak. It was the exact opposite. It was actually very, very strong. And Microsoft's firing on all cylinders. So you have Google with a buyout, right, of $70 billion worth of their own stock, buying back $70 billion of their own stock back. You have Microsoft that absolutely crushed. Okay, so when you sit and you look at this, it becomes very clear to me anyway, that the way that we were picturing that this quarter was going to go tonight did not go that way. And you're just seeing Microsoft get stronger and stronger. You know, their guidance is right in line with where they were last year. They're not even cutting guidance, which is pretty impressive. And Azure sales they're talking about 26-27% growth. So this is overall a really good quarter. Now, I don't know if you're going to be able to hold all this or how this plays out tomorrow, but overall, I would say that tonight was pretty productive if you were a Google shareholder or if you were just a shareholder of equities in general. And you can actually see the equity markets move up later in the day. But I would definitely be watching Microsoft tomorrow because there are a lot of shorts that are trapped in this. Have a good night, everybody.